Quack, quack, quack. Let's do it, folks. Good morning. Welcome to the Street's opening bell. That reference will make more sense in just a moment. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Wednesday, the 30th of November, the final day of the month. I'm your host, JD Durkin. Opening bell rung moments ago by Aflac. See, I told you it would come full circle. Yes, at both Aflac, longtime CEO Dan Amos, as well as, yes, the Aflac Duck himself, whose name, by the way, is the Aflac Duck. Major averages right now are trading fractionally down into the red after a pretty sluggish start to the week on Wall Street. Investors perhaps in better spirits. We'll see after recent data showed signs of cooling in the labor market, raising hopes the Fed may finally begin to ease its very aggressive rate hikes. We did get the ADP job figures today, as well as some GDP numbers. We'll see exactly as the day goes along how people are ultimately responding. But taking a look now for what is on tap for this morning's show, we will be talking jobs as recent data out of the market is showing continuing signs of cooling. Plus, we will preview Fed Chair Jay Powell's speech as investors anxiously await clues on the central bank's next move. You know what that's like, folks. Hang on to every single word the man says. And finally, we'll talk crypto as the fallout from the FTX fiasco continues. Does it ever? For more on those stories and so much more, we now bring in Mr. Martin Baccardax. Martin is our senior editor, our markets correspondent, our chief football correspondent as well. What a week to have those all those things top of mind. So let's talk markets here, Martin, appropriately so. Many people say 3 in a row makes a streak, and we've had 3 mostly down days for the indexes here. What's top of mind for you and you think for a lot of investors as we kick off trading on this Wednesday?
Well, really what I think I'm seeing in the market this morning, JD, is just sort of a crystallization of how difficult the task is of Jerome Powell, the Fed chairman, and his colleagues in sort of calibrating what is happening in the world's biggest economy and setting that against how it sees inflation developing not only this month, but in the months going forward. We had a series of releases this morning to paint a very interesting and very divergent picture for the world's largest economy. And as a result, stocks are reacting in kind. There's a cautious element to what we're seeing in the early trading, obviously, because Mr. Powell himself will speak later this morning. But the trend is downward, largely because what we are seeing seems to suggest further inflationary pressures. And if that is the case, it might mitigate any dovish hue that Mr. Powell could put to his speech later today in Washington.
So to the point about one of those data points we get, of course, the ADP payroll figures. We're going to wait for the government figures to get more of a clear sense come Friday, but this always gives us a little bit of an indication. But the numbers seem to be quite a bit lower than expectations. 127,000 new positions for the month. That's at least according to ADP. That's well below the 190. How do you interpret that particular data point ahead of Friday's BLS report?
The ADP number is an interesting bit of the mosaic, JD, but it hasn't been particularly predictive in terms of what we'll get from the non-farm payroll report. I mean, historically, it has been more associated with revisions rather than the headline figure itself. The data itself is reasonably granular because, of course, it's taken from the actual payroll receipts that are processed by ADP as a company, and that's the biggest company in the country as far as that's concerned. So it can't be completely dismissed, but they have only sort of designed the way that it collects figures over the past few months. So its reliability, whilst previously was associated with non-farm payroll revisions, is now largely in question because the data set just isn't really that old. But there's no question about it. It was certainly weaker for the month of November, and that does give rise to the fact that hiring might indeed slow heading into the end of the year. However, at 10 o'clock Eastern time this morning, we had numbers from the Commerce Department with respect to job openings, and that number was 10.3 million. It was a little bit lower than consensus, but nonetheless, JD, if we are seeing a slower pace of hiring with 10.3 million positions still left to be filled, it paints a very confusing picture in the labor market itself. And I think that's part of the reason why people are, A, focused on what Powell might say later today, but also B, sort of questioning their interpretation as to how quickly inflation will decelerate, because as you know, if there are more people, if there are more jobs, it's going to cost more to fill them, and that results in higher wages, which become embedded into the economy. So the picture is by far from clear, I think, at this stage, and the ADP numbers just kind of add to the confusion.
And if I'm not mistaken there, you were just referencing what is frequently called JOLTS, or Job Opening
Yes.
and Labor Turnover Survey? Yes,
Yeah.
I believe it's labor turnover. So you mentioned there the figure 10.3 million. Give us a bit more perspective, because this to me is the sort of data point, Martin, correct me if you think my reading of this is wrong, that usually when that sort of figure comes out, it's important, but maybe not quite as closely examined as we are facing in this particular environment, where we are poring over every individual data point for a sign of what that could mean for the central bank. How do we further interpret, if we were to step back a little bit, this current JOLTS survey, or the JOLTS survey number, versus how we usually read it?
Well, I think you're right in the sense that prior to the pandemic, it wasn't a number that particularly was market moving, hence its release time at 10 a.m. There were moments where it had resonance, but for the most part, it was a number that was more sort of focused on by the wonks, as opposed to people who are trading on a day-to-day basis. But since the pandemic, of course, and the resulting change in the way that all of us interact with our jobs and our careers and our work-life balance and everything else, it has become increasingly important, to the point now where it's very much a focus of traders, economists, and others, on a month-on-month basis. Because again, and I think the point is worth reiterating, if there are that many unfilled positions into the economy, it stands to reason that companies will have to pay more to have people come off the labor market sidelines and into the office or into the warehouse or wherever they might conclude their commerce. That is going to increase wage pressures, and that is going to flow through into the broader economy. It is something that has been alluded to by Chairman Powell on a number of occasions. He's talked about the tightness in the labor market, and he's expressed concern for the accelerating wages, which I would probably mention is still running significantly slower than annualized CPI gains. But those numbers are going to cross over at some stage. And I think the JOLTS numbers, as well as the non-farm payroll figures that we'll get on Friday, and indeed labor market indicators going forward, will begin to illustrate that more starkly. And as a result, investors might then wonder whether their inflation prognosis is correct.
Martin, you mentioned the wonks. Are you one of those wonks?
I am indeed, sadly.
Yeah,
Yes, I should be pitied
figured.
rather than scorned.
But listen, it's because of wonks like you that everyone else has a much better understanding. We always talk context here on the show, right? Because you do a great job bringing us the perspective and the sort of 10,000-foot view, not to get lost in the granular numbers. So I'm thankful for your wonkiness. Let's talk further wonky stuff, because that's what people are here to watch. The second estimate of the third quarter GDP. We did have third quarter GDP figures today. Perhaps better than expected reading. I think it was 2.9%. What does that tell us, that piece of data today?
It's interesting, the timing, and I'm not sure that it's entirely related. Well, actually, let me rephrase that. It is not entirely related, but the timing is interesting to me because the bump up in the revision for Q3 GDP comes so quickly after the spending spree that we saw over the Black Friday weekend. Consumer spending and business investment were a big part of the reason that we had that estimate bump. And as a result, the economy, as you mentioned, is growing at a 2.9% clip, or it did in the third quarter. The Atlanta Fed's GDP Now forecast says that that pace has actually accelerated to 4.3%. Now, there were a couple of data points this morning that might put that into question. There were pending home sales, which are down, I think, 37% on the year, and they're down for the fourth consecutive month. Chicago PMI data, which measures factory activity in and around the sort of a Great Lakes region, was a significant miss and actually sort of slumped into recessionary territory. And the bond market is flashing those same recessionary signals as a result of the yields on short-term paper being significantly higher than longer-term paper. But the data underneath, JD, and this is what's puzzling people alongside what they're seeing in the job market. Q3 GDP, nearly 3%. That's nowhere near recession. Q4 GDP ticking over well past 4%. Again, nowhere near recession. The Fed itself has said it's not part of their baseline assumption that we will slip into recession, but the bond market is virtually betting that it's a lock. So at the moment, we have those competing interests, and it's just fascinating for me to see them play out, not only in the data releases, but in the market itself.
Martin, I'd love to ask you about China, specifically. That COVID situation is something now at this point, it's nearly a daily topic that you and I talk about, and understandably so, because it seems as if there might be movements that happen overseas overnight, every night, that investors here stateside wake up to and want to know the latest on. Parts of the region there in China are reporting weaker than expected factory activity data. showing the lowest levels in 7 months. Obviously, we got the public health and public wellness part of the equation, but there's also the economic part of the equation, right? And I wonder to what degree the economics of it could begin to force the hand of that country to finally ease some of their harsh zero COVID restrictions.
That seems to be the binary assumption. And I don't even necessarily think that it's wrong, because ultimately, the thing that the Chinese Communist Party and the leadership probably has to ensure is stability, social stability. Obviously, they have bet that economic growth will ensure that. And that they will go hand in glove. It's a very managed economy, but nonetheless, the fact that it is growing, keeping people employed, and allowing a generation that previously wouldn't have even thought of the idea of property ownership, owning houses and apartments and everything else like that. From those measures, JD, it's been a success. And if we do wonder why a communist party with an authoritarian bent remains reasonably popular, that's part of the reason. The transformation of the Chinese economy over the last 40 years is one of the most astonishing things I think that we have witnessed really over the past 200 or 300 years. It rivals that of what was seen during the Industrial Revolution. So I can understand why people would assume that a slowdown in economic growth would trigger big changes in health policy. But my estimation is that the authorities in Beijing, they have more levers to pull rather than just simply a wholesale change in public health policy, particularly because the assumption is most of it was authored by Xi Jinping. The last thing he wants to do is, to be seen to do, is make a U-turn so quickly into his third term as president. So my suspicion is that what we will see is probably looser monetary policy, very likely fiscal stimulus, and tweaking around the edges of some lending practices and regulation and other things in order to entice the kind of growth that they need to ensure that economic stability that I was just mentioning. They can probably do that without the kind of significant and headline changes to health policy at this stage. But how long will they be able to maintain that tactic, and will be able to maintain that tactic, and will they be able to do so into the coming year? I guess that's the larger question.
But I think, yes, and I think if there's one part of this that may be really of direct importance to a lot of our viewers, is the outsized impact that Apple has on the markets. Of course, the biggest company in the world in terms of market cap. There has been a lot of chatter of people being very quick to highlight the last couple of weeks, Martin, the degree to which Apple has tried to retreat from being overly dependent on China. What more do we know on that idea? And are there other countries, are there other parts of the world that Apple is instead trying to reprioritize in terms of manufacturing and production? Obviously, I think, look, the headwinds for the upcoming holiday season are already pretty clear. But what is Apple doing that we know of to try and decrease its dependence specifically on that country, especially given all this volatility?
Yeah, there's a handful of things that Apple has been trying to do to sort of, wean its dependence off of that Chinese manufacturing hub. Obviously, we have Taiwan Semiconductor, which is a company that is one of the biggest chip making contract chip makers in the world. They're setting up a new plant in Arizona. And as a result, Apple is going to source some of its newer chips from that plant when it gets up and running in the next couple of years. Apple has looked to manufacturing facilities in India and Vietnam as well to try and lessen its dependence on China at the same time. But it's a slow-moving process. The infrastructure in China is not there by accident. It has been built up as the result of a number of years of policy directly from Beijing. And retreating from it is not something that can be done overnight. There's all sorts of parts to the supply chain, both in and out, that need to be manipulated in order to make it a success. So Apple, I am certain, is in the throes of doing so, but it's not the sort of thing that we're going to see the result of in the coming quarters or maybe even indeed the coming years. This is a probably decade-long process, but nonetheless, it's one that's ongoing.
Yeah, that's just an incredible dynamic to keep in mind. And thank you for the reminder of the timing, right? This is the sort of thing, this isn't like an adjustment or a correction to try and put themselves in better situation for like the next few weeks of the holiday shopping season. This is a long-term goal, but it is something that is understandably getting talked a lot more about as we do wake up to news, obviously on the economics, on the protests and a lot of the issues there. But as you correctly pointed out yesterday, there is perhaps a tendency of many to overemphasize some of those protests, not to diminish them or their importance or the power or bravery of those who are willing to step up and do them, but out of a country in terms of the scale that China does have, it's worth keeping in mind at least a bit of that perspective. And we talked about that yesterday. Here stateside, of course, we do have some people would consider maybe the most important man in the world speaking today. Not the president, but Mr. Powell. He will give remarks followed by a Q&A. What are you expecting?
I'm not sure what to expect. If you had asked me a couple of hours ago, I would have thought that perhaps he would add a dovish tint to a speech that is likely going to be focused on the labor market. He's going to take questions from the audience as well. He's speaking at the Brookings Institution in Washington. He's going to be quizzed by not only a moderator, but he'll take questions from the audience. And again, I would expect, or would have had expected, a bit of a dovish tint to that. But curiously, since then, JD, we had core PCE price index data for the third quarter. We'll get the October number tomorrow, but the third quarter number suggests that inflationary pressures were largely flat, and they actually didn't diminish over the 3 months ending in October. That's not great news for those who assume that it's turning in the right direction. And of course, we've had these labor market data that suggest still significant tightness that could bleed into wage pressures and therefore find themselves embedded into the economy. China's manufacturing data is also another concern, because if they are moving into contraction territory, and it certainly appears that they are, that is going to further disrupt supply chains and add to inflationary pressures on the goods side. Services side, of course, will be more affected by wages, but goods are going to be more affected by what we are seeing in China and elsewhere. So I don't know that he is going to be as sort of candid about his inflation assumptions as a result of that. I don't think he's going to be anywhere near as hawkish as he was in the summertime, when an address he gave at Jackson Hole completely upended markets, triggered about a 16% drawdown for the S&P 500, and pushed the US dollar to its highest levels against its global peers in about 20 years. I'm not anticipating that, but if the markets are looking for a dovish tilt, and certainly one of the rare dovish tilts from the Fed chairman so far this year, I have a feeling they might be disappointed.
Is there any calculation? You and I have talked about before the fact that Jay Powell maybe does not have the typical CV of others who have done the job. This is a Washington, D.C. guy through and through, right? He's a product of Gonzaga prep. He is a creature of the world of bureaucracy of Capitol Hill. And I wonder to what degree, now that we're past the midterm election, and I would never, allege that, that there's, obviously we talk about Fed independence. We know that there's a history in the history of the U.S. presidency. We know there's a history of improper pressure that gets put on Fed chairs in previous decades. Is there any sense that Jay Powell, being as political savvy as he is, while keeping in mind that he's not a political figure, he's not an elected official, is there any reason to think that now that we're through the midterms, that any of his thinking might change, that even how he talks about the issues, the delicate nature with which he talks about the issues, knowing that they could throw markets into this wild volatility, does that change at all now that the midterms are over and we're in the lame duck session, speaking of Aflac, and we're going to have a new Congress in a few weeks?
I don't think it's an outrageous question, JD. I do believe that he probably feels he has a slightly freer rein to speak about markets and about the global and indeed domestic economic picture as a result of the congressional elections already being concluded. I would imagine that gives him a little bit more leeway. But for the most part, I think you're probably right. He is cognizant of the impact that he can have on financial markets and will monitor his tone as a result of that. But if I go back to the period in which he was under intense pressure by former President Donald Trump to cut rates, when at the time that actually might have been seen as a good idea, even though inflationary pressures were bubbling up underneath to the point that they exploded post-pandemic, we saw him weather that. We saw him weather it with not only a decent amount of courage, but not a small amount of political aplomb at the same time. So I was impressed by that, and it really gave me confidence to think that going forward, this was not a man that was going to be bent by political or indeed public pressure, because the intensity of the commentary from the president at the time was significant to the point where people were wondering as to whether or not he was going to be reappointed. He obviously was, and having withstood that pressure, I don't imagine that's something that he is going to cower from in the coming years.
To this point about politics, I do want to stay with it because I'm reminded that before the midterms, you did have notable Democratic senators. Elizabeth Warren comes to mind, John Hickenlooper, Sherrod Brown in Ohio. They were pretty vocal in their criticism of the Fed. Again, this is in October, so this is before the midterm elections, when Democrats were feeling the economic squeeze. They sensed the political potency of those inflation arguments coming from Republicans. And the argument from those Senate Democrats, Martin, at the time was to say, raising rates is all well and good, but it does nothing to address the supply side pressures of pricing. Do you expect that type of political criticism to continue from Democrats? It's not something I've really heard a lot of since the midterms. Maybe I've missed it, but I wonder if that tune might begin to now sound a little different now that the midterms are over.
Imagine you have a toaster oven in your kitchen, JD, and you've put a bagel in it in the morning and you're looking forward to a delicious breakfast, but you've overcooked it and it starts to burn and there's smoke everywhere, right? And the fire alarm has gone off as a result. Now, one person in your kitchen might take a tea towel and start to wave it around in order to get rid of the excess smoke, and the other person might go directly to the toaster oven and get rid of the burnt bagel. Now, you could argue that the person waving the tea towel isn't doing any good and that the more important tactic is to get rid of the bagel, but that doesn't mean that the person isn't having some kind of effect. And it would be silly for that person to just sit there and watch the smoke billow and not do anything at all. So I think that, yes, you're probably right. The Fed's blunt instrument of interest rates aren't going to do much to affect the supply side pressures that we have seen in inflation, the toaster oven. But nonetheless, they do have that tea towel of interest rates that they could wave around and at least get rid of some of the excess smoke. And I think to a degree, that's what they have been trying to articulate. They have been sort of relatively clear that the result of the pandemic era buildup in supply chain disruption, which of course increased demand for goods that simply weren't available, is a significant portion of the inflationary increase, as was energy prices and all the rest of it. But they have also said that they still have to execute their mandate for price stability and full employment to the best of their abilities. And that is going to require some kind of demand destruction. And the only way to do that, at least at the present time, is through higher interest rates. So I can understand why lawmakers would see that as, again, waving the tea towel whilst ignoring the toaster oven. But I do accept what the Fed says in that it is better than not doing anything at all. And it really is part of their mandated task. And I don't necessarily blame them for focusing on it, even though I think most of us would understand that getting rid of the bagel is probably the most important part of the equation.
Yeah, but you've been there. I mean, sometimes there's like the bagel burns and you're trying to like scrape off the little top layer because you're trying to salvage it because you really need those carbs. Yeah. You're really trying to dig in. You're like, well, maybe if I can just like the top surface, it's still fresh. That might be one of the favorite, my favorite answers that you've ever.
I'm not sure.
You absolutely crushed that metaphor. I was about to say that's one of my favorite responses you've ever given. What is your favorite type of bagel?
Oh.
Yeah.
You know, I'm going to elicit a lot of criticisms of this, but I have to be honest. It's blueberry. You cannot beat a plain blueberry bagel. I know, sacrilegious as it might be.
Oh. No, I'm down with it. Cream cheese?
No cream cheese.
No cream cheese. Okay, fair. Back to, I guess, a slightly more important question. It's a great answer, though. If you were in the room with Mr. Powell today, what would you ask him? Have you thought about that?
It's a great question. Gosh, what would be the first question? If I had the first question in the press conference today, or indeed from the audience today, I guess I would say that I would ask, is the market correct in assuming a terminal Fed funds rate of around 5%? And would that change if inflation figures were to come in softer than expected in the coming months? I'd really want to try and pin him down as best I could into a this for that kind of exchange. In other words, if we were to see inflation maybe retreat to below 6%, would that change the Fed's assumption of a terminal Fed funds rate of around 5%? You'd want to try and lock him into something numeric. He would, of course, much like a great boxer with footwork to die for, maneuver around that question, reframe it, and answer it for himself. But nonetheless, I think that's probably what I'd ask.
That's a great question. And I also like that you know that, again, you're not talking about a politician, but you are talking about a beltway savvy individual. Certainly knows how to bob and weave his way through difficult questions that he doesn't want to. I'm sure he's very adept at that. He spent The man has spent a lot of time with members of Congress. I'm sure he knows how to do
No
that with the
doubt.
best of them. I do want to ask you about the Fed Beige book. It comes out 8 times a year. It's not something we talk about a whole lot, but today there's a lot of interest. Give me your sense on the Beige book and what further clues about regional Fed banks we might learn.
Well, I think you're probably right in the sense that it's more important now, in large part because we are seeing, if not completely different, at least slightly different views from some of the regional Fed presidents as a result of what they anticipate will come in terms of growth of inflation. So the Beige Book as a collective will provide at least some sense of how or if the Open Markets Committee can come together on a singular decision in December and indeed going forward. But I don't think it's going to be significant enough to knock anybody's views off of their perch. I think what it will do is provide investors with a little bit more clarity as to whether or not the Open Markets Committee and the Fed chairman are going to be on the same page, because it's worth remembering in the early November rate decision, the Open Markets Committee agreed to a statement that was seen as almost universally dovish, but it was essentially, if not contradicted, at least watered down by commentary from Chairman Powell himself when he spoke to the media about 30 minutes later. That suggested to me, at least, that there were differing views to the degree that Mr. Powell had to go out and tame market expectations. It will be interesting to see now whether this Beige Book allows for a more collective view or one that has differing opinions for the different regions.
I also want to ask you about Mr. John Williams. Unfortunately, not the musician, though we're all big fans of the work that he has composed. We're talking about New York Fed Chair John Williams. Of course, as we are in the midst of the most aggressive series of rate hikes, Martin, we've had in several decades, Fed Chair Williams said this week he expects inflation to slow, I'm not talking the federal funds rate, inflation to slow between 3 and 3.5% next year, to slow to those levels next year for 2023. But we know the stated goal has been 2%. So this is a version of a question I've asked you weeks ago, but since we did get those new comments from Mr. Williams, what happens if inflation is only able to come down to about 3 or 3.5% if the goal is 2%? What do we do?
I think it's going to be more about the rate of change as opposed to the destination, at least over that 12-month period, JD. If the Fed is confident that the arithmetic is going to bring inflation to 3% by the end of next year, and that will follow into a rate that's closer to 2% in the mid part of 2024, I don't think the Fed necessarily has to change too much of its strategy, because as long as they see it moving in that general direction on a consistent basis, they can feel comforted that what they have done in terms of rate hikes has allowed that to happen. What they will be more disquieted by is if there are bumps along the road. And again, from what we saw this morning out of China economic data, from what we're seeing in the labor market, and potentially what we could see in the energy markets into early next year, I think the prognosis for inflation is now starting to get a little bit murkier. So not only will it be the rate of change, but also whether or not that directional change will be consistent and not have lumps in it where maybe we might see higher than expected readings in the early part of next year and then lower than expected in the latter part. That would be a difficult situation for the Fed to hold on to its strategy. So ultimately, JD, I don't necessarily think that 3% or 2% at the end of next year will make much of a difference. I think it's going to be about the rate of change and the direction of change. If they can remain consistent, the Fed will feel comforted. If not, then all bets are off.
All bets are off. Okay, I do want to ask you about crypto with our remaining minutes here, Martin. Sam Bankman-Fried, founder of the now collapsed kind of punchline FTX, is now set to appear on a New York Times panel today. Oh my, I'm sorry.
I know. It's
okay,
impossible.
see, I woke up this morning and I saw something very, like in the 5 a.m. hour, I saw something about him making public comments today, and I kind of stored it away in the back of my brain. And it truly wasn't until, because our amazing producer, Rebecca, wrote this question, it was not until I just read this that I realized that that's what the event was. I'm prepared otherwise, I promise. What are some of the big questions that he will need to answer today? I wonder how long he's going to speak too. Can he answer questions all day? Because I'm sure there's lots of questions to ask the man.
God, it's such a multi-dimensional situation, isn't it? Ultimately, if you were speaking as someone who was offering legal advice to Sam Bankman-Fried, and there'd be no shortage of people who would do so, you would tell him not to answer anything, because he's putting himself out in a public forum, and he's going to face questions that would make him absolutely indictable for the situation that he's found himself in. Remarkably, he remains in the Bahamas outside of the jurisdiction of lawmakers, despite the fact that there's an $8 billion hole in the balance sheet of this collapsed company. There are credible allegations of the commingling of customer funds with the activities of the Alameda hedge fund that was wholly owned by FTX. There was terrible record keeping. The gentleman now who is tasked with picking through the wreckage of this multi-billion-dollar collapse has said it's one of the worst he's ever seen. And this is a man who went through the Enron sort of restructuring. So he is fairly confident in what he is saying. So the questions really are going to be about those issues, JD. Why is there an $8 billion hole in the balance sheet? What happened to customer funds? How did customer funds disappear after the company filed for Chapter 11 bankruptcy protection earlier this month? How is Mr. Bankman-Fried going to stand up and face the music as a result of what he has already admitted were lapses in concentration, is probably the best way to charitably describe it. But again, the fact that he is speaking to these issues in a public forum when there are so many jurisdictions that are looking for the truth and pressing him on these issues, and he faces significant legal risk, is really quite astonishing to me. Now, I want to add very quickly, JD, that I don't blame the New York Times people for continuing their invitation to him and participating in the Deal Book event. It's a big interview. It's a public forum. They have every right to do so. And the fact that he's agreed to it only makes them more justified. So there's no criticism from a journalistic point of view. But nonetheless, I just think it's just an astonishing spectacle nonetheless.
Oh, I couldn't agree more. I hope no one was criticizing the New York Times for that decision. Are you kidding me? They're probably sitting there looking at each other in the newsroom saying, wait, really? He's still going to show up? Are you sure? Wait, are you sure that's what they said? He's actually going to appear? So I agree with you.
I think that's
great.
Anyway,
listen,
he won't be there in person,
okay,
but he'll
at least virtually.
Yeah.
But listen, we've seen Elon Musk make a lot of high-profile virtual appearances at events like that. He tends to make massive headlines when he does it. No reason to think. I'm sure everyone will be. We're going to see these clips everywhere later today. This is going to be a wild event. Finally, what is your outlook on the broader crypto space in general? Obviously, we have seen others get swept up in this fiasco. But as you and I have talked about before with regards to the dot-com bubble burst a few decades ago, the underlying technology may not have been vulnerable, even if some of the biggest players have shown impropriety. So what is your current spate now that the dust has begun to settle? It's not nearly done. But what's the overall outlook right now for the crypto space?
Well, we haven't pulled the thread completely of the FTX collapse, so there's no question about that. So there is going to be weakness in the near term until we can understand which companies were exposed to it and what the level of exposure was. Obviously, BlockFi filing for Chapter 11 protection earlier this week suggests that other crypto lenders and companies in that space could also be vulnerable. And therefore, as a result, there could be forced selling of a lot of crypto assets as everything is unwound. But what's been interesting to me, JD, is the fact that Bitcoin prices have remained as stable as they've had through all of this, trading in that mid $16,000 range and seems to be holding firm. Now, it's a complicated thought process that has allowed me to come to this conclusion. But as skeptical as I have been of the entire crypto space, I'm starting to come around on the idea of Bitcoin itself. Not because I think it has any particular utility, because I don't, and not because I'm particularly impressed with the underlying sort of blockchain technology, because it's old, it's antiquated, it's slow, and its carbon footprint is relatively filthy. But what I do find impressive is the fact that in large part, Bitcoin assets are almost like stable coins in that because they have so many investors who remain locked in, it's almost as if they are dollar backed. And if they are dollar backed, they're going to hold on to their value in ways that we just haven't seen with a lot of these other crypto assets. So curiously, Bitcoin is finding its moment in the sun simply as a placeholder, I guess, if you will, whilst the entire crypto space sort of redefines itself. And for me, that's probably been the most outstanding headline of all of this.
Just an awesome conversation today, Martin. We hit on so many topics. I'm very grateful for your expertise. That is Martin Baccardax, our chief markets correspondent, also our chief blueberry bagel correspondent.
There we
Martin,
go.
Thank you. Have a wonderful day, my friend.
Great to with pride. Thanks, JD.
Great. Absolutely. We'll do it again tomorrow. See you then, man. All right. That's going to do it for the market open here from the floor of the New York Stock Exchange. Stick with TheStreet for more on these and all of the major market stories that matter to you, and we will see you tomorrow.